So one second.
And social auditor, Mr. Neeraj Agarwal, our learned member of our Bangalore Values Association. And I welcome to this session on a pleasant Saturday morning. So in the morning, we have a very interesting topic that is option pricing valuation from Mr. Neeraj Agarwal. See, as you have, all you know that say the new management committee has taken charge of the affairs of our beloved Bangalore Values Association. Now I request our president, Ms. Shilpa Kiran, to take over and introduce the members to the members and take it forward.
Thank you, Mr. Shiv Prasad, for your introduction. I welcome all of the BVA members for today's session. I'm glad to share about the new committee formation. 5th August 2023, we had the shareholders meeting of BVA. And the Vice President Education is now Mr. Ravindranath Narayan Rao. Vice President Public Relations is Mr. Venkata Rao Kalva. Vice President Information Technology is Sheetal Darak Mandana. Vice President Membership is Kaushik Raj Krishnamurthy. AVP Membership East is Mr. Manish Agarwala. AVP Membership West is Mr. Mayur Deshmukh. AVP Membership North is Mr. Munish Agarwala. Secretary is Mr. TVS Shiv Prasad. Treasurer Kusuma Devi. And we have an advisory council as well. Mr. Subbaraidu and Mr. Ramamurthy Srinivasan and Mr. Girish Kambudraya form the advisory council. I place on record my acknowledgement for the past committee and the immediate past president, Mr. Venkata Rao Kalva. During their tenure, the committee has reached great heights, increased its membership, made a mark in the valuation profession. And as you all are aware, we have been conducting many sessions during last year. And during the current year, the present committee intends to take up new initiatives like having a physical session to start with Pune, Delhi. We are considering other regions also. I welcome the members to please come, help us to increase our membership and contribute to the association activities by volunteering yourself. Yes, now I request Mr. Ravindranath Narayan Rao to introduce today's speaker and say a few words.
Yeah, thank you, Shilpa. All the best for your tenure. So it's my pleasure to introduce today's speaker, Mr. Neeraj Agarwal, a practicing chartered accountant for last 10 years. He's also a qualified register valuer and qualified social auditor. He's from Bengal. I mean, we have this Royal Bengal Tiger today to take us through the valuation thing. He's been also called on many occasions at various forums to educate people. And also he's been invited as a special invitee for our CA Institute's social organization. With this background, Neeraj, the stage is up to you. Thank you so much.
Thank you, sir. First of all, hearty congratulations to all the new members of BVA. Good morning to all of you. I hope you all had a wonderful week. I appreciate this opportunity provided by BVA to conduct this session today. I am Neeraj Agarwal, Chartered Accountant and a proud member of BVA. I hope with this session today, we will gain some knowledge on options valuations. Please feel free to ask any questions during the session, and I will try my best to answer them. I will definitely try to keep the session short and simple for all of you. So with the permission of all the esteemed members, I think we can start today's session. And let me just share my screen with you all.
In the meanwhile, I want to share a few words about Mr. Neeraj Agarwal. He's very much active on LinkedIn. And he has written so many articles on the social audit and its social audit um, areas, etc. And he has analyzed many states' budgets, and he has posted them on WhatsApp. He has got a large number of followers. Anybody who is interested in analyzing the state budgets, they can visit his page, and also topics on the social audit. Thank you.
He is
Thank you.
also our BVA member.
Of course.
Proud member, ma'am. Okay, so is my screen visible to all of you?
Yes.
Yes.
Okay,
You can make it slide.
yeah, sure.
Slide.
Just getting hand. I just something is hanging. I'll just start from here only. Okay, friends. So, option pricing valuation. I think most of you have heard about what is option pricing. It is not a very new topic, but it's a topic which is very vast, and a lot of people have written on it. A lot of topics are coming up, and as you know, with the new age technology, the new age startups, option pricing is the way forward. The world of valuation is a fascinating landscape, always evolving. We hear new technologies, we hear new caveats, some new equity structure which is coming up on a frequent basis. New age startups are hogging the limelight. They have come up with some interesting ways to compensate their employees and stakeholders through schemes like ESOP, phantom stock options, etc. And this has led us to ask as a valuer some certain questions when we are valuing these type of options. What are options contract? Who are the parties to an options contract? What are type of option contracts? How is option pricing done? What are different methodologies? I'll ask the members to keep their mic on mute. How is option pricing done? What are different methodologies used in option pricing? And which models to be used under various situations? The first three questions are fairly simple and fairly theoretical in nature. Our main concern for today's topic is the question number 4, 5, and 6. But obviously, before we start any sort of valuation, we will have to know what is options, without which we cannot move forward. Because as a valuer, if you do not have idea about what type of instrument you are valuing, then you cannot proceed with any type of valuation activity. So the first question is, what are options or options contract? To begin with, what is the option? What is option pricing valuation? We must know what are options. Options are a type of financial instruments. A holder of options contract has the right, but not an obligation to buy or sell an underlying asset at a generally predetermined rate after elapsing of a fixed time period. In some cases, an option premium has to be paid at the time of the writing of the options. So the last line is not mandatory, but it is generally practically that in most of the cases, you will find that some option premium is also being paid at the time of execution of the option contract. Major point for a valuer to check in an option pricing is, the first point is theoretical, that it's a right and not an obligation. The second point is the major point, which is an underlying asset. In most of the cases, you will see that option, there is an underlying asset, which is in most of the cases is an equity share capital. And as an option valuer, our valuation will primarily depend upon the value of the underlying asset. The third point is the predetermined rate, which is also sometimes called a strike price. Fourth point is the time period. Time period is of the essence because time will determine our valuation. It will have a huge impact on the option value. Lapse of option, when is the option lapsing? And lastly, the last point, which is the option premium, which is not mandatory, but it is practical and it is all there. It is always going to be there in most of the option cases you are going to see. The second question is, who are parties to an option contract? Basically, it is very simple to know that there are two parties to an option. One is the option holder, one is the option writer. From your point, from a valuer point of view, you need to ask the question that who are you valuing the options on behalf of? Sometimes this has an impact on your valuation strategy also. Now, this is another interesting question. What are types of option contracts? Basically, two types of option contracts are there. One is call option and one is the put option. A call option is taken when the price is expected to increase in the near future of the underlying asset. A put option is taken when the price of the underlying asset is expected to fall. Why I am talking about all these 3 points are because if you do not have the inherent knowledge of options and what type of option you are dealing with, then there is no way you can proceed with the actual methodology and valuing the option. So as a valuer, even though our job is to value the options, without having thorough knowledge of options, we cannot just move ahead and start valuing the options contract. And that is where the difference between a normal equity valuation comes, because most of us from our theoretical knowledge in our knowledge base from our CA days, we know what is equity share capital, we know what is preferential share capital, and etc. But option pricing is a topic which is not covered thoroughly in our subjects, in our CA subject or in our valuation examinations also. And that is why when you are starting in the field of options contract or options valuations, it is mandatory for you to know what is call option, what is put option, without which you cannot think of valuing the matter in hand. Till these 3 questions, if anybody has any specific question which they would like to ask, or if anybody had some examples to share with us when they did their evaluations of any sort of, and they had certain issues with what put options or call options, I will be glad to hear. These examples I'm not doing right now. Okay, so moving ahead. How is option pricing done? The dynamism of valuation is best reflected in options pricing valuation. A valuer needs to have a true sense of what the valuation option is in its spirit and what is the letter of the law on the option. Option pricing depends upon a concrete set of formula which derive the value, and some of these are discussed below. In the upcoming PPTs, we will be discussing some of the methodologies or some of the formulas through which we can do options valuations. Option value have to be derived irrespective of the underlying asset being listed or not listed. These options can be traded in the market also. These options can be traded in the market also. Hence, a fair valuation is required to determine the fate of the option holder at the time of execution. I think anybody here has done option valuation of an unlisted company? Anybody?
I guess it's about stock option valuation is also a option valuation, right? Or when you're valuing the ESOP issued by the company.
Correct. So any example or any experience, ma'am, you would like to share in when you did the ESOP valuation, what challenges you faced?
The challenges is it is like, at what point in time will the options will be exercised by the employees? I think that was the biggest challenge according to me.
Okay, the time period, the lapse.
Yeah, the lapse.
Okay. So in unlisted company cases, there are various type of challenges which we have to face, which we will discuss in the upcoming PPT, in the upcoming slides. what are the different methodologies used in option pricing? Option pricing models are based on probability and some assumptions. Since it is dependent on future value of the underlying asset, calculating the current value of the asset depends upon probability analysis. Some analysis also become part of the valuation if all the parameters are not available to us. Some specific models have been developed over the years to value options. So three of the most commonly used valuation methods we will discuss right now. So basically in this slide, what we are trying to speak here is that to value options, we have come out with some concrete formulas over the years, 60, 50 years down the line. A lot of formulas have been developed. And here in this slide, we will discuss three type of different valuation methodologies, which are most commonly used when we are doing options valuation. The three options, three formulas which are most commonly used are Black-Scholes model, Monte Carlo simulation, and binomial tree method. I think anybody who has done the ESOP valuation will be should be familiar with the first one, which is the BSM model. This is the most commonly used methodology, which is used when we are doing ESOP valuation also. Madam, did you use the BSM model when you did the ESOP pricing?
Yes, sir. That was the model that I used, Black-Scholes model. Yes.
Yes, sir. Any Mr. Ramarao? Moving ahead. So the first topic of the day is Black-Scholes model. Black-Scholes model BSM is also known as Black-Scholes-Merton model, and it's named after its developers Fisher Black, Myron Scholes, and Robert Merlon. The original model was developed in 1973, and since then there have been several modifications to it. The model uses the following parameters to derive its value: current stock price of the underlying asset, part B, strike price, C, expected interest rate or rate of return, D, time of expiry, and E, expected volatility. Now, if you see these 4 or 5 parameters which we have mentioned here, as you may know that when you are valuing an unlisted company, point A becomes a challenge, because in a case of a listed company, underlying asset is readily the value of the underlying asset is readily available. You can take the value of the stock market, whatever is which BSE, NSE, whatever, wherever it is listed, you can take that value. But what about when you are valuing an unlisted company? Then where do you get the valuation? Any answer to this? Anybody?
For this, I think we'll have to do a regular valuation where we do the DCF valuation or the market multiple approach or what.
Correct, correct.
Yes, this is what I have also done. First, we have to derive the stock price from the DCF valuation. Then based on that, the BSM shall be applied.
Correct, sir. Correct, ma'am. Point B, the strike price is generally mentioned in the options contract. So there, even in case of unlisted company, it should be available to you. Now the expected interest rate or the rate of return, this is again, in an unlisted case, it becomes a bit difficult to get. So I will discuss in the upcoming slides what we can do to what type of information we can use to get these returns. Point D, time of expiry, is going to be there in the options contract itself. Point E, expected volatility. Again, this is going to be a bit of a challenge in case of an unlisted company, but we will discuss what we can use in the upcoming slides to get the expected volatility for an unlisted company.
Mr. Neeraj, I have one doubt. This time of expiry, these
Yes,
days, many startups are issuing like open option, like even if the employee leaves also, still it's okay.
Perpetual options.
So that also you can highlight.
Yeah, ma'am, that is also going to come up. So some of the assumptions of BSM models are: the underlying asset is the equity of a non-dividend paying company. Now, this is the assumption of the first BSM model, which came out in the year 1973 and all. Post that, there has been certain modifications. Now, with the help of softwares and other parameters, even for dividend paying company, BSM model is being used. But in the original methodology, it was an assumption that the underlying asset is a non-dividend paying company. Point 2 is markets are random. What does this mean? This basically means that market is not following any sort of pattern. It is randomly moving. But even though with so many rules and regulations and so many information now being available online, it is very difficult to say that markets are completely random. Obviously, you cannot put a range to where the market will move, but with thorough study, most of us know that what type of movement the market will have. So to say that market are completely random is a wrong assumption in today's time. Point 3, there is no cost in acquiring the options. What we have mentioned earlier, that nowadays most of the time there is some options premium. So again, this point 3 of assumption is a bit wrong in today's term. And point 4, all options are European options. So what madam just said, that nowadays we are having a lot of open options, perpetual options, but BSM model is mostly of the assumption that all options are European model with a fixed time lapse, and the options can be executed only after the lapsing of the period and not before that. So these are the basic 4 assumptions of BSM model. Now, anybody has any question regarding the 4 assumptions of the BSM model? Okay. Moving ahead. So this is the basic formula of the BSM model. I'm not going to bore you people with this explicit formula discussion, because this formula is available online. You can check it. There are Excel sheet workings also through which we can derive the BSM model workings. I also have prepared one Excel sheet, and with time permitting, we will see that Excel also, that how we can put BSM model workings in an Excel sheet.
Hello.
Sorry.
Hello. Yeah, I just had a query related to this.
Yeah.
So since in this BSM model, as on the point number 4, you have mentioned the all option are the European option. So the at exact time only we can exercise the option, right?
Correct,
but if
sir.
the company has the, for example, some instrument are issued that after 3 years they can exercise their call option or put option at any time. So we cannot use that BSM model for those cases. Is it that?
No, so see, as I told you, that BSM model, when it came out in the year 1975, these were the inherent assumptions of the BSM models. But now with a lot of modifications, people are using BSM models in the cases of American options also, which does not have any fixed time period.
Absolutely.
Or even in case of dividend paying companies, the BSM model is being used because of the software which have been developed. These softwares and all, they have certain modifications. They have done some modifications to the original model. And now even for perpetual options and all, BSM model is being used. But when you do some type of valuations in which these type of open-ended options are there, my suggestion will be to, if you are going with a BSM model, always go with use another method just to see that whether you are on the right track or not. And in these open-ended evaluations, sometimes it is better to use 2 to 3 different methodologies and give the client 3 different type of scenario analysis, instead of just giving one methodology answer through the BSM model. But yes, all the inherent assumptions of BSM models have been rectified to some extent via modifications. And nowadays there is no specific assumption which is there that you will see that because of this assumption you cannot use a BSM model.
Okay, so do we have to make a certain modification, or is this is the only formula we can use for that particular transaction as well?
This is the basic formula of BSM model. Okay. But now, for example, this formula is not using the dividend paying model. If there is some dividend, then dividend yield has to be reduced from this price of the underlying asset. Okay. Because what happens if it's a dividend paying company, then the underlying price of the underlying asset will reduce. So there are now modified formulas which has come up in online, is available, which will show you that how you can use BSM model for dividend paying stocks also. Because if you see 6 out of 5, maybe 4 or 5 out of 10 stock on the listed listed stocks are paying dividends. So BSM model, when it came out in 1917, that time dividend paying was not a regular phenomenon. But nowadays, almost every company which is listed is paying dividend. Even unlisted companies pay dividend to their foreign shareholders and other stakeholders. So
Right.
to say that we will not use BSM model for dividend paying company will mean that BSM model will no longer cease to exist. So that is why there have been so many modifications over the year. But
Okay.
modifications as a valuer, we can use the modified formula. We can use the softwares available in the market, all the Excel sheets in the market. As a valuer, our role is very restricted because we cannot go into the deep dwelling of these Excel formulas and statistical analytics.
Yes. Okay. Thank you.
Yeah, my pleasure, sir. Now, any questions regarding the BSM? We will try to solve one BSM solution in an Excel sheet also later. But theoretically, if anybody has any other question before we move to the other model. Okay, moving ahead. The second point is Monte Carlo simulation. This is one of my favorites because this model is very much based on probability analysis. A Monte Carlo simulation is used to model the probability of different outcomes in a process that cannot be easily be predicted using the intervention of random variables. It is a technique to use to understand the risks and uncertainty. The Monte Carlo simulation takes into account some key assumptions when calculating the pricing of the options. Some of these are: Monte Carlo simulation assumes perfectly efficient markets. The number of simulations is large enough to produce reliable results. The inputs are independent and randomly distributed. The outputs are normally distributed. So the four to five assumptions of a Monte Carlo simulation is that the markets are perfectly efficient. Now we all know that markets are not perfect, neither efficient. There always a room for some sort of arbitrage when you are doing the market. So this pure assumption is wrong. The number of simulation is large enough to produce reliable results. If you see the entire market, yes, the number of simulation will be large enough. But when we are using it for a private limited company, for an unlisted company, then the data pool is very limited. The inputs are independent and randomly distributed. It means that the inputs which we have taken are all independent of each other and are properly distributed. The key inputs of market simulation, Monte Carlo simulation, is same as that of a BSM model, which is the current market price, the exercise price or the strike price, the annual volatility, and the time taken. These are the four parameters through which Monte Carlo simulation also work. I will also show Monte Carlo simulation in an Excel sheet if for the education of people who have not done it. It's a very interesting model. Anybody here has used the Monte Carlo simulation earlier? If not, then I will first, with your permission, I will share one Excel sheet with you. Let's see. Is my screen visible now, the Excel sheet?
Yes.
So this is a basic simulation run which we did for one of the clients. This is actual data which we did for one of our clients. This client had a put options on an Indian subsidiary, and we had to value the put options, and this was a perpetual option. There was no timeline. What we did was, madam, this will also, I think, some way answer your question also, Shilpa ma'am, that what to do with perpetual options. So what in this scenario, what we did was, we did two runs, which was one was through the BSM model, and the other one was through the Monte Carlo simulation. This is the Monte Carlo simulation which we have run. So the parameters which we have taken here is the spot price, the strike price, the time taken. Now, as we discussed, this is a perpetual option. There is no timeline. So we have to take different timelines and execute it. So if you see, we have taken like some 6 to 8 different timelines in this scenario. The first is what happens if the put option is exercised after 1 day, 1/365. This is T when for 6 months. Similarly, we have used for 1 year, we have used for 2 years. This way we have used for around, we have taken around 7 to 8 different parameters. Coming to the first parameter, when we have taken the T as 1. Now the volatility. Now if you see that this sheet, this is Monte Carlo simulation peer. Peer company means that I have taken the figures of a peer company of this unlisted underlying asset. So in my case, the asset which we were undervaluing was the underlying asset was a unlisted company. I did not have any volatility or annual returns for it. Similarly, I even did not have a time period because it was an open-ended perpetual option. What I did was that I have taken this volatility of a peer company, of a listed peer company. The volatility calculation for 1 year I have taken, and this volatility has come as 54%, which is on the higher side. For the interest rate, what I have done is the annual return rate is I have taken the growth in the EPS. So what I did was that this unlisted company last 3 to 4 years, what is the rate of increase in the growth in the EPS rate? This is what I have taken as my interest rate. Now this is the annualized return because we are taking a 1-day job. That is why I have calculated it accordingly. And this time period has been taken in a way that this annual the return for 1 day has come up. Again, the volatility, which was the annual volatility, again I have taken the time volatility for the time period of 1 day. Now, if you come to my simulations, if you see each time taken of I have run a 10,000 simulations. This way, we have taken 6 different time periods. 6 different time periods. We have used 10,000 simulations for each, which means that for this client, we have run around 60,000 simulations. Now, this is the standard model of Monte Carlo simulation. What is Monte Carlo simulation? It is just a random theory. It gives you random simulations, what can happen in different scenarios. So what has happened in this case is that we have taken the t equal to 1 day. And in this 1 day, different 10,000 different scenarios we have predicted through the Monte Carlo simulation. So this simulated return has come from normal distribution. If you see this formula, we have used a random probability. Now, what does this random probability does is that this gives you random solutions to different scenarios. So whenever even if you click anything, for example, if you just press F2, you see the entire figure changes because this is random. It is giving you random calculations. It will keep on changing. So please make sure that when you are using a formula of a random theory, then make a picture of it. Your final table, make a picture of it because this table will keep on changing with the slide. Even if you press F2. That is the difficulty with this Monte Carlo simulation random movement. It will keep on changing. So if you have taken a figure of say call value of 351 rupees, and then when you are trying to show it to the client and by mistake you press F2, this will change to 338. Because this is random calculation, it will keep on changing. So now what we did was we did run a 10,000 simulations for all of this. And for 6 different cases, which means that we ran around 60,000 simulations for our client under Monte Carlo simulation. And this is the table. So when T is 1 day, when T is 6 months, when T is 1 year, when T is 2 years, when T is 3 years, when T is 4 years, different scenarios we have taken. And under each scenario, our options, we have taken the median of the 10,000 simulations which we have run. So for example, in the first case, I was valuing a put option. In the first case, my put option has come as 0 in all the scenarios. So the median for 0 is also 0. Okay, it is 0.0035. So you see then the first case, the scenario, it is 0, the put option is 0. Similarly, when we have taken the t equal to 5, the put option comes to 263.25. This 263.25 is the median of the 10,000 simulation which I have run. Similarly, all the 7 to 8 cases, we have put the figures here, and then finally we have made a median of all this average, and we got a median of 563. So as per Monte Carlo simulation, the put option is 563 for the company when we have taken the parameters of a peer company. Now this peer company, the volatility rate was very high, 54.5. I will also tell you what peer company I had taken. The company which I had taken was AWL, Adani Wilmar. So Adani Wilmar, from the year of its listing, it had a very volatile ride in the stock market. Soon after listing, it almost doubled, and then after it, with the Heidenberg report, it fell down drastically. That is why the volatility rate of this amount is very high. So why we have done this is because with the company which we were doing it, apart from Adani Wilmar, there was no other peer company which we could have taken. So what do? Should we just keep that the figures which we have taken for Adani Wilmar and give it to the client, or should we do something else? Because this 54.45% volatility for a company which is in the FMCG sector, it is very, very high. FMCG sector is generally on the lesser volatile side. People who do regular share market and all, they must be knowing this. So what did we do? We did a second simulation. In this simulation, we changed the volatility from Adani Wilmar to the normal volatility of the entire FMCG index. And we got a lower volatility. And we have taken the total return of the FMCG index from the NSE index which we can get. And this way we have run all the simulations. The 6 simulations for 10,000 each taken. Again, you see that we have run around 60,000 simulations for this. So when the volatility is very low, the put option is almost negligible. Can anybody tell me what does this mean? What is your option? What is your analysis from this change in the volatility? Our volatility has fallen down from 54 to 16% approximately. But because of this, the put option has almost become negligible, 0. Can anybody give me an answer to this? Why such a scenario happened? Anybody can take a hint. Anybody can
it says that the value of underlying asset or the value of option is rising. The price of the option in the market is rising.
Ma'am, you're somewhat right, but not.
The put option value has gone down.
Yeah, so you are somewhat right, but what exactly does this show is that when the volatility is very low, the spot price of the equity is already on the higher side. If you see, if you come here, you see the spot price is already higher than the strike price. And if there's no volatility, then the chances of the spot price going down to the strike price is negligible. So if the volatility is only 16%, there will be very less chance that there will be a scenario in which the spot price will go down, will become lesser than the strike price. So this is what this analysis is saying, that since the spot price is already higher than the strike price and the volatility is very low, in such a case, no option buyer will take the put option on this underlying stock, because it's a very low moving stock. It will not have a high range of volatile or random movement in its portfolio. So in the short to long run, the spot price will not fall below the strike price. And this is what this analysis is actually trying to prove here. And sir, when you have asked me that whether BSM model can be used for perpetual and American options, so this is a prime example of an perpetual options. This client had a put option on one of its subsidiaries, and it was a perpetual option. What we did was that we did 4 different type of analysis. One was Monte Carlo simulation using the peer company. One was the Monte Carlo simulation using the Nifty index. One was BSM model using the Nifty index. So again, here the parameters used are for the Nifty, but we have used this entire table for BSM model, and we have got different solutions here. Again for BSM model, we have run 10 to 11 scenarios when the time taking is different, and we have got a solution to this. And now this is the last one. This is for the BSM model when we have taken the volatility of the peer company, which is AWL. Any questions so far on this table? Because this table can be a bit confusing, especially Monte Carlo simulation.
Sir, if there are multiple peer companies, then the simulation will go up to 60,000 plus.
So
The
simulation
multiple.
running is your call. What I will say is that when you are doing it from a peer point of view, don't run all the peer company evaluation separate. Then you first take out a median of the peer. So if you have 3 to 4 peer, then you make out do an averaging or a median of the peer volatility. Don't run 4 different peer solutions. So if, for example, I will not tell you to, if I had 3 other A, B, C, and AWL as the peer company, I would have not run 4 different simulations, because that would have mean that there will be around 250,000 simulations which I have to run. And ultimately in these perpetual options, you cannot put a specific price. You will have to give the client a scenario analysis. So the more the simulations you run, the more different options will come up. In our case, we give the client 4 different options using 2 different methodology, which was BSM model using peer as well as Nifty, and then Monte Carlo using the peer as well as Nifty. Now, if we would have used 3 more peer, then the overall solution would have gone to 6 to 8 points. Then it becomes difficult for the client also to judge which is the best put value to take for its accounting purposes. So if you are lucky enough to get 3 to 4 different peers for your underlying asset, then you first make a median or make a call whether you want to do median or averaging of those resulting peer group parameters. And then with that result, you run your simulations. Now, again, this Monte Carlo simulation, there is nothing written that I did was 10,000 simulation. You could have done 1 lakh simulations also. There's no harm in it. There is nothing written that it has to be 10,000 simulations. You can do 1,000 simulations also. You can do 60,000, 1 lakh simulations also. That depends upon you.
Thank you, sir.
Why I'm showing BSM model and Monte Carlo simulation here in this Excel sheet is that these 2 simulations I have also run in Excel sheet, and these 2 simulations are quite easy as compared to other methodologies to be run in Excel sheet. So I have never run a binomial tree model in Excel sheet because I am not that great with Excel when it comes to VBA methods and VBA and all. Anybody here has done any sort other type of option valuations using Excel sheet, maybe using the BSM model or any other type of models apart from BSM and Monte Carlo? I will share that Excel sheet, sir, and the PPT with you all. Anybody has tried to do the binomial method? There is no, I have no shame in answering the fact that I have never done the binomial method using Excel sheet because it is very, very tough. But anybody here who has taken up the challenge? Okay. So this is the Excel sheet which we have. This entire working is an actual working which we did for one of the client. So all the figures or the data are actual figures and not an hypothetical analytics. So what we did was at the end of this report, we came out with 4 solutions and we gave it to the client because this was a perpetual options. We did not want it to put one finger on one specific amount, that this is the amount you will have to give your put options. So we gave him 4 different solutions. Now it is up to the client internal management to decide which is the best suited for them. Because in perpetual option, the issue is with the timeline. There is no timeline. So you don't know when it will lapse. Now what we have done is we have taken 6 to 8 different scenarios. If you have the bandwidth, if you have the time, you can even take 20 timelines. That is up to you. But somewhere down the line, you will have to take a call that what is the maximum permutations and combinations you can use when you are doing evaluation for a option for these type of perpetual options. And more cases nowadays are moving ahead, and they are going with these American or perpetual options, with these being open-ended. There's no timeline nowadays because we are now moving away from the traditional European options into these type of options pricing. So everybody will have to take a call that whether they want to do these type of sensitive scenario analysis or they want to put a figure on it.
Neeraj ji,
Yes, sir.
in this Monte Carlo analysis, so what I understand is that we have to arrive at the one spot price and strike price. Spot price is we can arrive at the valuation of the company as on the date of the valuation. But for example, if the promoter or the company who is investing, if they are having the option, put option or call option, then how to arrive at the strike price?
The strike price will be there in the options contract. It has to be there. Something has to be there. In our case also, the strike price was not specifically mentioned, but it was, there were certain clauses which were mentioned through which we could derive the strike price. Because see, when you are talking about the perpetual options, already you are not giving me the time period. And being an unlisted company, you are not giving me the volatility and the return. Now, I will not even give you the strike price, then don't give me anything. I will put 0 there only.
No, but sir, how to arrive at the strike price? So, because I have also seen one or two contracts, but there also the strike price was not mentioned because like Docomo or something like a big investor, when they invested, they are having just a call option or put option. There are certain conditions, as you rightly mentioned, that if these conditions get triggered, then they might have the call option, put option activated. But how to arrive at the strike price?
So if you read, I think they will have to put some figure to it that if the conditions are met, then the strike price may be X amount or the strike price may be 75% of the spot price. Something has to be given in the contract. A contract cannot have a vague or no strike price clause. There has to be something.
Okay.
Either that will be a very specific amount, or they will say that the figure derived by the registered value or spot price less 25% will be the strike price. Something like that. In our case, if you see, this strike price was a direct variant of spot price only. So whatever the spot price came was, the strike price was, what I remember, was around 15 to 20% less of the spot price. That was our agreement. Okay. So something has to be given, sir, because you are not, see, out of the 5 parameters, 3 parameters already you are not giving me properly. Now, even if you don't give me strike price, then what will I value with? My valuation cannot be entirely on assumption basis, right? Some figures have to be there.
Okay.
Now, when we are doing situation analysis, time we can take different, because since there is no timeline mentioned, we are taking different timelines to do our situation run. But what about strike price? How can I put any strike price? Because I don't know what will be the price at which the option holder will exercise the option, and that is not my domain.
Mr. Neeraj, I have a basic doubt. Okay, what are the scenarios where the valuer is expected to do this? You know, in a normal scenario, like employee stock option is one which we have understood. Other than that, whether any other situations this is prevalent in the market, which as a valuer we are expected to do this option valuation?
Madam, there are a lot of, apart from ESOP, you will hear about phantom stock options also, which has come up. I will discuss that also in my slide. Apart from that, in this case, this was not, this matter which we had just discussed in the Excel sheet, this was not a case of any ESOP option. This was purely an investor had a put option on its subsidiary. So there also, for the what we did was, we did the valuation from the point of view of the investors, because investor had to value the put options it had on the Indian company. And this investor was a Singaporean company. So what basically we did this valuation for the Singaporean company, not for the Indian subsidiary. And we had a discussion with the Big Four, because their auditor was the Big Four, and they were of the opinion that we have to give 4 to 5 different situations, because one situation cannot pertain to a case in which the time is not fixed, because this is a perpetual option.
And SCR, stock appreciation rights also?
Correct.
What do you mean by investor had a put option in subsidiary? Exactly what instrument it was?
Without going into the entire exact details of the clause, ma'am, there was some, what I can give you, that there was a one investor, for example, a investor had invested in Indian company. Okay, with the knowledge that within 3 years, this Indian company will go for an IPO. if the IPO is not done within 3 years, then this option get triggered in which the investor has the right to exit the company on the strike price. Okay, but the investor can exit, and after 3 years, the investor can exit anytime. There is no timeline through which this options will lapse. That is why this becomes an American option or a perpetual option. Better to say perpetual option than to say American option, because in this case also the option could have been executed only after the trigger event, which is the non-happening of the IPO.
Okay.
I have
So
one hypothetical case, that what happens is that, that during the bridge round, normally in a series, I will issue a bridge round in such a way that, the discount to series A round. So once the series A round is happening, that even the bridge round fellows will not be converted to preference to equity because they have a 20-year tenure. So do you think that we should do a option valuation there, or we should move on with the regular discounted cash flow?
So can you just repeat the question properly? Like I could not understand.
Okay. Now in a series A, that bridge round before the series A, what happens is that we normally issue a, that we take a preference shares with the saying that certain percentage of discount to series A round. So it's not a valid round.
Yeah.
Valuation will not be done during that time. So when a series A is happening, now we do, as far as the series A is concerned, a valuation which is a discounted cash flow or any other method which is appropriate method, we will be adopting. But as far as the options of these guys are concerned, whether we should adopt an option method or we should, that we just, because they'll not be converting it the series A round. They'll just, that it is discount to that, but it is shares are not quantified. That since the preference shares has got a 20 years tenure.
Mr. Neeraj, can I take this and then you can correct me?
Please, ma'am.
Actually, Mr. Shivdat, definitely, I got your point. What is the formula mentioned in the agreement with respect to conversion? Okay, whenever floor or cap and whatever is a valuation, all of this, you apply the formula once Series A funding price is arrived at, and we arrive at the conversion price for the bridge round, and we just bring to the attention of the board of directors that yes, this is the conversion price according to the formula we have agreed. So whenever any dilutive shareholding pattern is made after this calculation, you just have the converted price. That's all. No separate valuation is required, is my view. And Mr. Neeraj or anyone can correct me.
I think I totally agree with you, madam, regarding this value.
Okay, thanks.
But I suggest it be minuted and noted so that, or else it will be just left.
Yeah, one more question. What made you to evaluate the value of the Singapore holding company? Because the options were in this company, correct? No,
No, I did not.
subsidiary company.
I did not value the Singaporean company. I did the valuation for the Singapore company, but I did the value of the put options which the Singapore company had on the Indian subsidiary. So my appointing authority was a Singaporean company, but I was doing the valuation of their investments or their options, which was on the Indian company.
Okay, so they were the investors.
Correct. They were the investors. They had a trigger. Can you speak? Thank you. So just to repeat the terms, the Singaporean company had invested an X amount in the Indian subsidiary with the option that within 3 years the Indian company will go for an IPO. If the Indian company did not go for the IPO, then this put option get triggered, in which the Singaporean company will have an option to exit the Indian company. Now the Singaporean company, as on the date of the valuation, they did not exit the company, but they had this put option on the Indian subsidiary, right? So in their books, they will have to value these options, this put options.
Okay. Got it. Thank you.
Yeah.
Mr. Neeraj, I have a doubt. In case of a startup, okay, suppose there are perpetual options given to the employees. Can I simply say that BSM is not applicable because we are not aware of the timeline, or because you have done this as a working paper, should I also consider that in my working papers?
Ma'am, that is entirely as a valuer your call, because because if the perpetual option is, it is the case of a perpetual option, BSM is not the correct methodology to be used. But what I have seen is that in the cases of startups also, most of the financial management of the startup, they are very, they are comfortable with BSM model. Even the venture fundings and all who are coming, they are also comfortable with BSM model. So sometimes what happens is the BSM model is the go-to method for all these startups. But it is, as a valuer, it is your call whether BSM model is something which you want to go or not. Because in my case, I did not wanted to go into binomial tree model in this Excel sheet workings and all. So I wanted to show them two separate models. So in my report, I cannot share the report with you, but in my report, we have put out this clause that BSM model is not the exact model. It has some inherent limitations regarding the American options or perpetual options. And why are these inherent limitations are there? Because when the BSM model was formulated in 1970s, there was no concept of a perpetual option. So the makers did not have the know-how that there can be a situation in which there will be no timeline. There won't be any T. So that is why. So it is, as a valuer, it is your call. But then you will have to see what other methodology you can use. Monte Carlo simulation is pure. It is purely probability analysis, nothing else. Okay, so can you put your entire valuation based on Monte Carlo simulation? If you ask me, no. It can be a second methodology, but it cannot be the primary methodology. Now the third option is the binomial tree model, which we will discuss, but we will discuss it very shortly because binomial model cannot be run in an Excel sheet. Or somebody can, if somebody can run, then hats off to him. And I will obviously ask anybody if anybody has done the binomial model on an Excel. I have not done it.
Yeah, you can go ahead. And just want to tell all the participants that 9:30 we have a hard stop. So since the speaker is available for clearing any doubts, please clear your doubts as and when you have it, because we have a hard stop at 9:30 for a demo session.
So I have one quick query on two counts. Now, some of the ESOP schemes that we come across, they said that when they issue, they are sometimes, in case of a startup scenario, they are more comfortable with having non-voting class of shares issued. Now, when we do that as the basis, now the FMV of the share price, we can never take the share price, share value, underlying share value as it is, right? We need to also create some sort of a discounting on the share value when we actually pick it up. Isn't that right?
Definitely. So if you're using the BSM or the Monte Carlo simulation, then you will have to have two separate spot price. One for the normal common class of shares and one for this preferred class of shares in which the voting right is not there. So probably in such a case, you will give further discounts in the spot price when you are dealing with some type of equity which does not have a voting right.
Okay.
And we will be using one. We will be touching base with one of another model which is not commonly used. That model is exactly for the scenario which you are saying.
Okay, and one more query I have. From a practical standpoint of time, standpoint, where predominantly we see when ESOP valuations are run, they are run as BSM itself, considering it like a European model. But more and more schemes that I see, they give a lot of exit options at different point of time and at different scenarios, saying that you might buy back, or you might convert, or you might have an IPO. They have multiple scenarios actually built in. So how do practically people approach such kind of option valuation for ESOPs?
Ma'am, that is why if you just wait for 5 minutes, I will also show you another methodology which is very common in America but not being used in India right now. But with our structure also become way more complicated for BSM models and other models to be used. Different type of models will come into play. One such model I will show it to you just after this slide.
Perfect. Thank you so much.
Yeah. So the third model, which is most commonly used in India, is the binomial option pricing model. I'm written here that it is one of the simplest method, but believe me, it is not simple. Only on theoretically it is simple, but you cannot run it in an Excel sheet. It assumes that over a period of time, price of underlying asset shall either increase or decrease. The probability of a uptick or a downtick in prices of the underlying asset is drawn for different time period interval. This way, a probability tree is drawn. The diagram beside describes the working of a binomial option pricing model. While the diagram only reflects two models, in real life, this can be done with hundreds and hundreds of levels, thus giving the diagram a tree-like picture. Binomial method is best done with the help of softwares. So what the binomial does is, this is a very good model if you see for the American options or a perpetual options, because you don't have a timeline in perpetual options, right? So in binomial option pricing model, you can get different scenarios. You can, in each scenario, there can be two probabilities, one of a downtick, one of a uptick. Uptick means that the price of the underlying asset will rise. Downtick means the price of the underlying asset will fall. Such a way you can define different probabilities, different scenarios, and draw them in a binomial tree. Obviously, when I say draw, it does not mean that you start drawing it. It means that it's a formula which you have to run. That is why when I say that binomial tree is very difficult to be run in an Excel sheet, and I do not have any Excel formula to show here for binomial. If anybody have run the binomial tree in Excel sheet or any working, if they can show it in this session also, we will be very glad. But I do not have right now any practical showing for binomial method. We have done it in a software and run in a software and all, but never done it in an Excel sheet working. Any question regarding binomial tree method?
One of the questions. So, binomial method is something that you can use in case of American options, right? Considering different scenarios of either 3 or 5 years or 6 years, whatever be the construct, can we do that and try to use a binomial?
Correct. So binomial tree is see, if you construct a binomial tree over a very long horizon, you will see that somewhere down the line, the value which is coming, it will start reflecting the value which is coming in the BSM model itself. Because when you run a very the n number of probabilities, when you have a very high number of probabilities, then all these probability, when taken in an average, it becomes almost the amount will come which will be very near to a BSM model. But yeah, when you are talking about American model, when you are talking about perpetual model, actually, then binomial model is a better way to go ahead. But again, for binomial model, you should have a subscription to a proper software. Don't go with a maybe some Excel sheets are also available online, but I will not recommend, because I don't think so they give a true and fair picture. Anything else, ma'am?
So, sir, which software would you suggest for this?
I don't specifically remember, but I can just check and send you in WhatsApp group, sir.
Yeah, thank you.
Now, ma'am, the other question which you have, the earlier question which you have asked, whether for complex structure. So this is one of the methodology which is being used in the US market, which is called the OPM backsolve method. And this is typically for the complicated capital structures which we find in the US market, which is now becoming day by day common in the Indian market also. Backsolve method, practically, I have not used it. I have seen the valuation being done in for US entities. It's a very complicated method, but it's a method which is used when the equity structure is very complicated. You have different type of classes of shares. It's a special application for the method of valuation. The method is based on the idea that there is an economic relationship between different classes of securities in the company that has a very complex capital structure. So what happens is that this is mostly used in the 409A valuation cases in the US market. And it is generally used for companies in which there has been very limited to no transactions in the common class of the shares, but there has been certain recent transaction in the preferred stocks. So when you have a valuation of the preferred stock, then how can you derive the value of the common stock? This is one of the method which is being used in the US market, and this OPM backsolve method will now become a very common method in the Indian market also, because of the day by day complexities which is coming in our startup valuations also. But I have not done this right now. I have seen this valuation for a US company but I have not used this valuation because it sounded and it looked like a very complicated methodology. Anybody has done this in practical life, OPM backsolve method?
No, I've actually seen this OPM backsolve, like you said, for a 409 evaluation. But for me, when I was going through the model, the inherent constraint I was looking in that model was that it was taking, there again, you apply BSM in an OPM backsolve. And there you're taking the time to expiry as, say, a probable liquidity event where they assume it to be a certain period like 1 year or 2 years. Now, my query here would be, if anybody can actually give me an insight into it, is that in case of an ESOP where you have multiple time periods, like 3 years, 5 years, a vesting period which is spread that way, or an exercise period which is a longer period, how do you use this and build into this model is my query. Where that I felt, because the time period was always kept as a liquidity event, 1 year, 2 year, or a specific time period, and they run the 409A. And 409A typically, I think it requires up to 1 year or 2 years as a specific time period is specified under the IRS requirement. I'm not too sure, but most of the ones that I've seen has got something like that as a limitation.
Not more than 3 years, what I know. Generally for
So
409.
typically our expiry periods for any of the ESOP options would be more than 3 years, but should be any time within 8 years. Considering a liquidity. So
that
how
is
do
why
you build
that is why what I believe is that 409, this backsolve method will have some sort of Indian modification when we start valuing it. But I think it has certain qualities which we can use in our valuation, because this methodology was based on the fact that the capital structure is going to be complex. So why we are not using it right now is because this complexity in our startups have come up in the last 5 to 7 years, and we have become very comfortable with BSM models and all. But I think over the time we will also have to switch to such type of complicated methodology, because BSM model has its own inherent limitations. It has so many assumptions that it cannot give you fair value every time.
Hi, Neeraj.
Hi, sir.
I did valuation using the OPM backsolve. So there is a
great,
big challenge. Big challenge is the time to liquidity.
Hmm.
When it comes to see, we will be based on the multiple capital structure. We are going to arrive at Series A, Series B, Series C, and also options or warrants. So we will arrive the price. The biggest challenge is there, the time to liquidity. So time to liquidity for the series, when we are doing a valuation for CCPS for financial reporting, the time to liquidity is different, and ESOP valuation, what we arrived option value using a backsolve method, the time to liquidity is different. So there will be a little challenge whenever we are using this model. In my case, luckily, the time to liquidity, both the options from ESOP option as well as CCPS, we have considered as the same. So 6 years. So based on that
But
one,
how
we
did
have
you consider the same, sir? Like there was anything written in the contract?
Not in the return. See, the option life of the ESOPs, it will be a 10 years. So, and also the time to 8 years, sorry. So the time to liquidity, what they've considered as the same conditions of the CCPS. So liquidation event, it will be IPO, M&A, and also that definitive agreement between the shareholders, timeline has been given, liquidation event. So in this scenario, it will be the same. If suppose is a different scenarios, we have to arrive the option, what is the share price or option price using the OPM backsolve method. Then again, we have to use a Black-Scholes model based on the different timelines. But the biggest challenge is that one time we already distributed this when we are arriving the price, the distribution is already happened. If you are using again Black-Scholes model to arrive the option price, double distribution will happen. So
correct,
that
sir.
will be...
We had the same issue, sir. We had exactly same problem where I applied BSM post this OPM backsolve. And the problem is for me, I was thinking exactly what you had mentioned. The distribution
it is the
is again
biggest,
you're doing.
Again, we are doing
How
a
does
double
it actually...
distribution. Double distribution should not be done.
Correct.
So that is what where we have concluded. Okay, luckily it is the time to liquidation event, because of the conditions is exist, it will be a same. Then whatever the price is arrived, you have to apply a delock, because for the ESOPs it will be a minority shareholding. So hence we have applied a DLOC after arriving the price from the OPM backsolve. Then that price has to be considered for the purpose of financial reporting. But time to liquidity whenever differs between these two, so there will be a little challenging, and double distribution should not be happen. That is what the conclusion what we have arrived in this valuation.
So my point for this is that because backsolve method was basically derived because of the IRS 409A clauses, and there I think they have the limitations of 1 year or 2 years. I think 2 years maximum. That is why this limitation is there with the time period.
So even in that scenario, so if it is a 2 years, it is there, then we have to consider the CCPS, whatever it is, that then time to liquidation event also we have to consider 2 years.
No, sir, but you cannot consider when you're doing it for an Indian company, because you cannot put the IRS clause here.
Oh, okay. From Indian perspective, yes. Okay. Indian perspective, it is a different.
Some sort of modification has to be
agreement.
Some sort of modification has to be there in this methodology, because this methodology is very much enriched. It is very it has come up because of IRS regulations. Okay.
Yeah.
Its inherited limitations is that IRS valuation will not give you more than 1 year or 2 year timeline. Okay. But in your case, if you're doing it for 7 to 8 years, then there will be a challenge. And that is what I
no, but this is Indian company. It is not a 409A valuation, but it is an Indian company where the multiple capital structure is having the options, warrants, and various CCPS.
Okay.
No, this is what I'm just telling you. So this is what is biggest challenge. This is time to liquidation event. So, but we can arrive the price using the OPM backsolve method for the purpose of CCPS financial reporting, as well as what is the option price. So that we can arrive using this method. But only challenge it comes when when we need to use a different time to liquidation events, then it will be a biggest challenge. We cannot use a double distribution. That's what the argument which is coming out.
The challenge right now is because it is not being used in the Indian market so frequently. Once we start using it frequently, there will be certain modifications to the original concept.
Correct, absolutely. But it is there. Okay. So I have done a 2 to 3 valuations using this method. Little difficult.
Yes, sir, it is difficult. I totally agree with you.
And moreover, if it is the latest funding round, it is there, then well and good. If it is not there, another challenges it will come.
But so that is the case that I think because this is a challenging method, the fees is also commensurate with it. If,
yeah, absolutely. Yeah.
That's the major. Because now people have become so common with comfortable with BSM models and all. Also from the fees point of view, also this is one of the method which we should be using.
Absolutely. No, this is little. We need to understand the complete the capital structure and seniority in the which one, and there will be a multiple. Recently, we have done one session on also on this one.
Then
there
I will
be a different
you to give a separate seminar on this, because I have just put it for theoretical purpose. You are already having practical. I will request the CA team to conduct a session with you, sir, for this method.
Sure.
Already we had completed first one, but black solve Rajesh has done. I was not aware. So.
Okay. No, I'm just pitched because this is what practically we are facing the problem in terms of the double
this problem again and again, because when I came to know about this, because now the American parent companies who have investments in India, so they are also insisting on such type of valuations only because they are comfortable with this type of valuation methodology.
Yeah, no, I have seen in the 409A, the maximum they're using this kind of methodology, OPM backsolve, and arrive the price, and afterwards they're applying a DLOC and DLOM.
Correct.
So that is there. But in India, in the predominantly in the startup ecosystem, it is coming out based on the multiple capital structure. If a single capital structure also they can use it, but if it is more complex, then it will be more difficult for us. But ultimately, we are using the Black-Scholes model only there also.
Okay.
Thanks.
Rajesh, may I ask a couple of questions?
Yeah.
In fact, it's open to Rajesh, Neeraj, and whosoever wants to take it. One, all the option pricing If we are in case of Paxol, when we are having this option pricing and different pricing for different series, my understanding is, and the underlying assumption is that they have got liquidation preference. And that is what we are valuing for liquidation preference, what should be the value of the option. Now, whatever formulas, whatever valuations you have seen, that takes into account only liquidation option, or they take into account option for conversion also. That is question one. And second, this option pricing, would it be taxable under the income tax or not?
Okay. So second
Actually,
question.
that is,
Yes, sir, Rajesh, please.
no, liquidation preference plus conversion option. See, we are arriving what is the total enterprise value or equity value. We are giving to a multiple capital structure, what would be the based on their preference, liquidation preference, as you said, that is right, liquidation preference and conversion ratio. So first, they will be having a seniority in each of the liquidation preferences. Suppose a CDC, how they will negotiate? They will negotiate, I need a more liquidation preference, or maybe a one time or 1.5 time, or maybe a 2 times, or maybe a fixed amount also. So that will be the out of the enterprise value. First, liquidation preference will go to a Series C, then Series B, Series A. Then post to that one, whatever the equity shareholder, and post to that one the conversion option, it will be a 1:1 or 1:10, whatever it is, that based on the remaining portion, it will get allocated to them. So that is where the total, out of the total equity value, the proceedings, what they're going to get it for them based on the liquidation preference ratio and conversion ratio, or is there any other amounts specified, or participating or non-participating, based on that rights what they're having, based on that one, it will get allocated.
No, that's fine. So I'm not clear whether the valuations which are being done, it values only liquidation preference, or it values liquidation preference as well as conversion option.
Yes. That we have to bring in the OPM backsolve whenever we are doing. So we
It
are
values
going
conversion option also.
Yeah, yes, absolutely.
Okay,
We
so
are going
to me, like what I say, that the underlying commercial transaction is liquidation preference, not conversion option. My point of view. And it should be valued only liquidation preference.
No.
Why I'm saying
okay.
so, let me finish. So why I'm saying so, I saw a valuation where the valuer has valued that the normal share is 100, and under Paxol, whatever series is being issued, it is of 150. It's a tech company. I asked the valuer, okay, so if the company goes belly down, if it tomorrow becomes bankrupt, there are no assets. It's tech company. The company, the person investing in it is likely to get zero value. No. So are you giving 50 rupees the value for giving the liquidation preference? 50% value. Would any CFO be willing to pay that kind of price? Say this is the model, according to the model, this is the value, and this is what we go ahead. Commercial transaction and all that, I do not understand. Second question was, what will be its tax treatment? If the share is 100 and it's being issued at 150 rupees, would 50 rupees be taxable or not?
Okay, from tax treatment, okay, I have to relook into. But from a liquidation preference point of view, if you have only 100 rupees is the liquidation value, then obviously it will go to your first preference holder only, right?
Neeraj, any comment on that?
Pardon?
I am asking Neeraj, any comment on the question, on my question?
No. You see, you're telling that it is a liquidation preference is 100. Suppose is one investor is invested 100, is having a liquidation preference amount is only 100. So there is nothing is left over for the conversion option for them. So obviously it will be 100 rupees is the worth of that CCPS holder, right? Hello.
Okay.
Okay. So, and from the tax treatment point of view, so we have to, if it is getting transferred, then we have to look from a 56 to X point of view. So whether the consideration is adequate or not. Neeraj, sorry, I just.
No, my question on tax was if 150 is the price at which CCPS is being issued and it will be converted into 1:1, equity price is 100. Would
Okay.
50 rupees the differential, which is the value of the option, will it be taxable?
Oh,
Will
not
it
sure
be
about
taxable
that.
in the hands of the
So
company?
why will it be taxable? And for whom it will be taxable?
In the hands of the company.
The company is getting 100 rupees equity in 150 rupees, right?
Right. The company is getting 150 rupees for CCPS because and the underlying share price is 100. 50
Okay.
rupees, 50 rupees is the value of the option.
Okay.
So this value of the option which company is getting, is it capital receipt or revenue receipt? Will it be taxable or not taxable?
I don't think so it will be taxable, but if anybody can tell me why it will be taxable, then we will be, but I don't think it should be taxable because it's a premium, right? It's a capex item.
No, it's not. It's the charge for the option which the company is charging to the investor.
So you are saying that it's an option premium of 50 rupees?
Yes, yes.
Option premium typically is what I know.
Chargeable. So
Chargeable
if
to
we
tax.
okay, so that's where back solve, if we do those kinds of valuations, to me, I have not done any, I have seen a few. To me, it seems that we need to be a little cautious and this subject needs to be a little studied in probably in detail. Maybe somebody have already done that. What exactly we are doing, and secondly, what are the tax implications?
Definitely, sir.
Okay, please carry on. I talk quite a bit time.
Okay. So moving ahead, the last option methodology which we will discuss today is, again, it's a theoretical. I have not seen any Indian company doing it right now. It's a Heston model, which was named after Steve Heston. It's a type of model which it is basically based on the fact that it believes that the volatility is not static, it is random. So anybody, again, my question remains the same. Anybody has used this Heston model when they are doing their option valuations? Rajesh sir, you or Naveen ji?
I have never heard about this. I have never done this.
Okay, Rajesh ji sir?
No.
Again, sir, the only difference between what this model and a BSM model is that in BSM, we always keep the volatility as a very fixed. But this, again, it's based on probability analysis or more of a scenario analysis in which we have different type of volatility. We believe in this Heston model, they believe that the volatility is very random. It is not a fixed or a very static figure. That is the basic difference between the other methodology which we have used and what Heston model talks about. But practically, frankly speaking, I have not seen this model being used anywhere right now, except for a couple of US-based companies.
Maybe sometimes when we are using contingent consideration at that point of time, it may helpful.
Yeah.
Because the revenue volatility, EBITDA volatility, if we are looking, so then probably that may not be a consistent. So then probably we can use it, but not in the options not seen.
The only the reason for me putting this here is to know that there are methods apart from the common three methods which we use. There are other methods also that we should have some knowledge about, and if some practical assignment comes in our way, we should not be totally blank about it. Now, how to calculate in unlisted company cases, which we have already discussed, is that in my Excel sheet also, I have shown that in cases of unlisted company cases, we have taken different approaches. We have taken the volatility and return based on Nifty indices, and we have also taken the volatility and return on nearest peer companies. What I don't like is the fact that in some valuation cases, I don't prefer that people, they value using different 3 to 4 parameters, and then they mix it up by using an average method of all the 4 or 5 different scenarios. You can't cook tea and coffee simultaneously, mix them and consider the resulting drink to be optimal. So that is what happens if you use the BSM model for a peer company and then you use the BSM model for a Nifty, and then some people, they average it out. So I never really prefer this type of averaging out of 2 or 3 different type of parameters. But anybody, if they can tell me why averaging is the best method to go in my Excel sheet, the working which I've shown you, then we can discuss about it also. In my Excel sheet, I have taken out 4 different scenarios and I've put those 4 different scenarios in the report. But sometimes people, what they do is all the 4, they will average it out and get a number, which I don't prefer in such type of cases. But if anybody want to contradict me, then please feel free to do so.
I agree with you that there is no point of doing a random averaging. What I do normally in this kind of scenarios, that like you said, you leave it open to the management, whatever they want to pick, you put all the numbers in the report, and the management can decide what number they want to pick. The other option could be, which I use, that for the different scenarios, what the management put the probability, and those probabilities, then you take the weighted average of.
But who will give you? Management will give you the probability.
Right, like you said, that you put it to the management, whichever option they want to pick. So that leg is closed in discussion with the management, that for the different scenarios, how much probability they look at.
Okay, sure. Now this is a model table which I have prepared. This may not be right for everybody. This is just an illustration of what type of methodology we can use for different scenarios. It is not 100%. This is my experience. Anybody can feel free to contradict this also. So while different valuers can prefer different methodologies while valuing options, I have in the below table tried to outline various scenarios of valuations.
Mr. Neeraj, 1 second. Are you showing us something? We are seeing your PPT only.
Yeah, I'm only showing the PPT in this. Can you see the table? With
No, we can see other types of methods. Anyone use this method, Heston model, only that.
Okay, sure. I'll just re-share the PPT.
Yeah. Yeah, now we can see the tick and the check.
Yeah. So this is I have prepared different scenario cases in which we can use different type of methodologies. Obviously, everybody has their own preferences, and this is nowhere written in any law that this has to be used for this type of option. So when valuing American options, I prefer the binomial option pricing model if it can be executed, because Black-Scholes models and Monte Carlo simulation, because of the time variance, because of the lack of time in American, because of the flexibility in the execution of the options, Black-Scholes and Monte Carlo simulation is not the correct or a preferred way for me. But obviously, option pricing, it thoroughly depends upon the valuer's perception. The second is when valuing the normal European options, all the three methods are fine. You can use the BSM, Monte Carlo simulation, or the binomial option pricing model, whatever suits your way. Third is when valuing perpetual options. Again, in perpetual options, just like American options, the preferred option will be binomial option pricing model because of the fact that there is no specific timeline. Binomial model is based on the fact that there can be different situations in different timelines. Point 4 for listed companies. For listed company, because again, in listed company, the key inputs of the BSM and the Monte Carlo simulations are available. And that is why in such a case, BSM and Monte Carlo simulation are the best methodology to be used. Changing rate of interest, again, with BSM model and Monte Carlo simulation, if you have different change of in the returns also, you can draw different probabilities and use the BSM Monte Carlo for interest if you have different rate of returns also. If anybody has any other solutions to this scenarios, or they think that something can be added, please feel free to add. Now we will move ahead. Exams, ma'am, you had asked me earlier example of cases when option valuations are required. One is ESOP. We all know about what is ESOP. ESOP is the employees stock options plans. Everybody knows about it. Even my office clerk is now asking me for ESOP plans. So we will have to start giving our article trainings everybody now ESOP. So in Ind-AS 102 obviously mandates a fair valuation of the share-based remuneration schemes, whether ESOP or SARs also, but it does not mandate the use of any particular method valuation. So again, in ESOP, when you are valuing an option, it is purely the call of the valuer, what is the best method to be used. Another case is the phantom stock options. Now this is again, if somebody, few people don't know what is phantom stock options, it is a contractual agreement between the organization and the recipient that bestows the recipient with the right to receive a payout on the basis of stock prices of the organization at a future date or fulfillment of certain conditions. So what is the difference between a PSOP and an ESOP? In PSOP, you get the employees are given a sense that they are going to get an equity in the near future, but no, they are not going to get any equity in the future. What they will get is they will get a price appreciation of the equity in the near future. So there is not going to be any stock equity allotment in the near future. That is why the word phantom, which means a ghost or a figment of imagination. So how to value these PSOPs? PSOP valuation can be more or less be done according to how we value ESOPs. One condition is, what I feel is that when you are valuing the underlying asset of, in the case of a PSOP, do not take the valuation which is of the spot price as same as what we have taken for ESOP. Anybody can tell me why? In the value of the underlying asset in cases of like PSOP should be a bit lower as compared to when we do for cases of ESOP. Anybody can give me some clue why so? And this is not the law. This is my overall assumption or experience.
Marketability discount is not required.
Marketability, yes, you can say, ma'am, or you can say the point that ultimately in ESOP also will be going to be some equity which will be allotted in the near future to the employee. So even though he will not be having a controlling stake in the company, but still he will have some equity or some voting right in the company. But in the cases of PSOP and all, there is not going to be any voting right to the employee. He will just get a cash reward in the near future. And that is why when you are evaluating PSOPs, it is basically, it should have some discount as compared to when you value something like an ESOP. I think with this, our topic for the day is almost over. Some of the write-up which I've written and which you can refer in on PSOP is in Tax Guru. It is available on the Tax Guru website. Apart from international valuation standards also I've written. These are all available online for you to go through. My concluding remark for this entire session is that while we have tried to dwell in the world of option pricing with this PPT, they are different methodology. For me, the best methodology still for usage is BSM model, which was, even though developed before 50 years, it still continues to shine light on the world of option valuations. But obviously, everybody will have their own comfort with the options valuations, and everybody will have their own comfortable methodology which they would like to use. With this, I think my presentation is over, but please feel free to ask any questions regarding the session.
Mr. Neeraj, I have a very basic question I have, whether it is necessary, mandatory for a valuer to use two methodologies, or it will be only his background work?
No, there's nothing, madam, there's nothing written anywhere that you will have to use 2 methods or 3 methods or 4 methods. It is purely on your own comfort level. But my suggestion is that when you are using a methodology, if you're using 2 or 3 methodologies, then you put those in the report, because you have already done the hard work. Then why not show it?
Correct. And practically, how does it happen? Whether clients, they do mention us like this is the range in which we want the, I mean, see, we have seen that in equity case.
Ma'am, you are asking something which is very underlying.
It's a closed group.
Definitely, ma'am. Definitely. Put option and all, there's always going to be pressure from the client to value. There's always going to be pressure. But what I feel is that in case of the options, because the parameters are so stringent, because you have the fixed formulas, you cannot just, because DCF method, correct me if I'm wrong, DCF method, the client can play with the projections. But in this type of valuations, you cannot play with anything because the parameters are so fixed. Once the only thing which the client can play is with the spot price, if that is also the case, if it's an unlisted company. And technically, so the players which get involved in these type of put options, from in my case, the company which I was dealing with was a Singapore company. It was an MNC. So there the Indian subsidiary do not have much of a play to really pressurize us to have this valuation done in such a manner.
Okay, but the variable remains only spot price, is it?
See, variable in unlisted company cases, the variable can be the peer, the inputs you are taking with the peer also. So now for the peer also, you are depending upon the client, right? You do not know what is the peer of the client. You can check it on online, but somewhere down the line, you will have to rely on the client also. So there also you can say that, okay, if the client gives you 2 to 3 peers which have a very high volatility, then obviously the amount will vary. But that is why with this 3 to 4, so that is why the client, in our cases, for example, the client was insistent on AWL using as a peer. But we insisted that we will then again use the NSE index also for FMCG sector. And that way we got two very, very different type of valuations. So as a valuer, even though you have a sort of responsibility towards the client also, but you have a responsibility towards yourself also, that how you want to put the value. That is why it is always better in option valuation to have two to three different scenarios. And don't be afraid to put those options, those different scenarios in your report. Because it is not, in option valuation, you will have, in different scenarios, you will have that one scenario the figure is coming 100, in the other scenario the figure is coming 2 rupees. So don't be afraid of such a fact that how such a huge difference of bandwidth is coming, because the parameters are different.
Okay. Thank you.
My pleasure.
Mr. Naveen, we have seen that the phantom stocks or SARs are sometimes equity settled and sometimes it is cash settled. Will that make any difference?
Again, ma'am, if it is a equity settled, then the stock price or the spot price will you can change. You can take it in a higher side. If it's cash settled, then you should give a discounting on the spot price of the underlying asset. That is where the major difference will lie.
In case, see, we do option valuations for financial reporting purposes. Already management has certain set of assumptions like life of the options, like they are exercising within 6 months or within 1 year. So when we do, like previously one valuer would have done, now we are doing this assignment. So for consistency purposes, we are not in a position to change the assumptions.
So when you say assumptions, first, if the timeline is not defined in the contract, then assumptions you can take your own assumptions. So I will, what you can do is that even if you do not want to change the assumptions of the previous valuer, you can add your assumptions also. You can add different scenarios also, right? So if the value has taken 6 months or 1 year, then again you can add another 2 years or 3 years for your own report.
Okay. No, there are certain cases where the company itself mentions the assumptions in it, like notes to accounts or significant accounting policies. There is a mention already. We are assuming the life of the option, especially life of the options thing. So would there be any kind of inconsistency, like if we, for our, from company's point of view, like every time they take a different assumption, whereby it could affect their accounting?
So if they're reporting it in the financials, how come the auditor is if there's so much inconsistency, the auditor itself should not point it out?
Okay.
From a valuer point of view, your role will come later. From a statutory auditor also, because company in a case of option, if the timeline is not mentioned, company just cannot blatantly write any sort of assumptions on the timeline. There has to be concrete reasoning for it.
Okay.
In our cases, for example, why we did was we took so many different situations because the company explicitly said that we are not going to give you any sort of timeline because we cannot put anything in written paper that this is the timeline we are going to maintain. And that is fine because when you are holding an option or a perpetual option, if you put anything in the timeline, then the entire entire fundamentals of the option gets elapsed. That it is no longer a perpetual option. You are already defining the timeline.
Yes. Thank you. Thank you.
Actually, I have a question.
Yes, ma'am.
There are two companies. One startup company, their exercise is happening regularly every 6 months. Okay. Since the exercise price is very less, they are cutting from the salary and it is in as per the scheme and then they are going ahead. There is another company wherein, they have left it open, perpetual. So when the CA is expensing the, ESOP, they are telling only, this company where every time it is happening, automatically the CA is expensing. But in this perpetual option, the statutory auditor has raised a point. On this moment when I am auditing, I am not at all clear as to what time they are going to exercise. Maybe they will not exercise also. So they have said that I will permit expensing, not just in the Companies Act, even in IT, both places, only when I am sure, yes, they have exercised. In the financial year, they have exercised. In that year only, I will go for expense provisioning. So, can you just...
Is it right from a company that point of view? Because this is not question of a valuation. This is a question of a company that point of view, whether the auditor can tell the company that they will not going for any provision. Because provisioning from a point of view is that provision cannot be 100% accurate. It is not required to be 100% accurate in a way. You're provisioning it for it, right? Because when you have already given an ESOP, you will have to take a probability analysis that there may be a case that this ESOP will be vested and this will be the amount of the expense the company will have to bear. So from my angle, the auditor just cannot 100% say that this is not, I'm not going to provision anything. Obviously, there can be certain probability analysis again, that what is the probability of a option being vested in the historical sense. And accordingly, when you have derived the option valuation, then take a probability calculation. So for example, for every one option, if 0.30% is the vesting which is being exercised, then you take a 30%, some sort of probability analysis you do, and that amount you expense it out. But to say that I will not expense out 100%.
Sorry, the question was, Companies Act, they said yes. Income tax, they said they will not consider. Sorry.
Income tax, ma'am, that is a different call, because the income tax, obviously, because I'm not very clear about the income tax part also, to be quite honest. But Companies Act, I'm pretty sure that they should be taking the provision.
Companies Act, they have agreed. Sorry, I missed the facts.
Income tax, if somebody does the income tax practice properly, they can, in a better way, to tell us what is the rules in income tax. I am not that clear regarding the income taxation point of view for these options.
Okay, the auditor was of the view that in the financial year, when the employee has actually exercised, in that year they want to exercise.
Yeah, because I think they income tax, they do not want to go for the provisioning part, because it is not income tax has certain clauses, I think, so they do not want to go into that. So they will write it off, and then again in the income tax point, when actual vesting comes, then they will expense it out in the income tax.
Vijaya, are you there? Can you hear me? Vijay is our admin. 1 minute.
Yes, ma'am.
Sonam
yes,
has joined.
Not yet, ma'am.
Okay. Anyone else has any doubts? Please raise it now. In just 2-3 minutes, we'll be concluding this session. Mr. Shivprasad?
Shilpa, just to take you to income tax, that there are few landmark judgments in that. Yeah, that one is of Agarwal, where the High Court itself has said that, that that's not a correct method, that you have to expenses over a period of, that period of life of the ESOP. And
Be a
of
little
course,
louder, please.
yeah, there are landmark judgments in that, that quite a few of it. The tribunal has held, and even High Court of Karnataka has held it, saying that expenses should be over life of the ESOP. It's not that when he is exercised, that you have to take into consideration. That is not a correct method of doing it. But of course, that I think there are few matters which are before the Supreme Court also. So as on date, that whatever the judgments are there, it is not when he is exercised, it is over the life of the ESOP.
Yeah, thank you. Mr. Neeraj, would you like to take the point raised in chat by Apurva?
Just looking at it. Is it Apurva, from pure financial reporting purpose, is it mandatory to certify ESOP valuation for unlisted companies? If yes, who can do the same? Fair valuation definitely understand would require valuation by RV. I think Apurva, yeah, for ESOP valuation for the purpose of financial reporting, it has to be done by the RV because it is done as per Companies Act, and Companies Act is only giving the registered value or the right now.
Right. But also, like the different methods that we just discussed, we'll have to put it in the reporting format, and that also has to be signed by RV, right?
So RV will give its own valuation report. In the disclosure, financial reporting disclosure, obviously RV signing will not go.
Okay.
But the company will obviously give all the details, the disclosures. If you go into any listed companies also, you will find they give a very explicit and very comprehensive disclosures regarding ESOP. I do not find so much disclosures when we see the same in the private limited companies or startup cases.
Understood. Yeah. Okay. Thank you so much.
Yeah, Mr. Shiprasad, you can go ahead.
Well, friends, it is a wonderful session. Thank you, Mr. Neeraj, for accepting our invitation to take the session on option pricing. And we look forward for more session from you to share your knowledge, your experience, your exposure to option valuation. Today, you have covered the various methods of valuation, option pricing valuation, like Black-Scholes, binomial, then Monte Carlo, OPM, Black-Scholes, and Heston methods. The last two, which are mostly not known to many of us, you have thrown light on the new areas or new methods of evaluation. And you have also demonstrated one of your workings, one of your assignments which you did, and you have shown how they are calculated, etc., in detail. Thank you very much for your concern for us in sharing the knowledge. And as an appreciation, a token of appreciation, we present you a memento, and which will be sent to you later. As I already told you, we look forward for more sessions from you. And this program is well received by all the participants, and you know that some of the participants have actively participated in the discussion, and they also have shared their experiences, their reviews, their methodologies, which they adopted, etc. And this type of interaction is more invited and more helpful for us, so that everybody can share their experiences, their knowledge, and their methods of doing an assignment, etc. Thank you, and please accept our memento as a token of our love and affection, and thanks to you.
Thank you, sir. Thank you, sir. The pleasure is mine.
Actually, I would request all the participants, we can take a break for 5 minutes. The venture intelligence demo will start shortly. The vendor will be joining soon. And thank you so much, Mr. Neeraj, for a wonderful presentation. It was very much informative, and we look forward to the PPTs shared by you.
Definitely. Thank you. Thank you, sir.
I request the participants to submit the feedback form, which will help us as a committee to give us, exactly what you require, what topics, what speakers, and in any suggestions you would like to give, please feel free. I request everyone to be in the same link, in the same session. We will join back in 5 minutes when the vendor of Venture Intelligence joins back.
Neeraj, you may share this PPT for the benefit of all.
Yes, I will do.
Thank you.
Chetan,
Yes, Shilpa. Morning. Good morning.
can we start?
Yes, I think Sonam has
Sonam?
joined.
Yeah, Sonam, can you hear us? Vijay, can you stop the recording?
Shilpa ma'am, can I stop the recording?
Yeah. Sonam, can you hear us?